The S&P 500 within striking distance of record levels, and the small cap Russell 2000 adding to its recent hefty gains. By the way, small caps, they're on pace for their best month of the year. Wow. All of this brings us to our talk of the tape and some questions heading into 2024. Because while things are pretty good, there are, as always, some challenges on the horizon. And let's welcome in Adam Parker of Trivariate Research, also a CNBC contributor. And Adam, I'm told that you are here to answer all of our questions, like what's the meaning of life and others. But I guess we'll have to keep it to the stock market and CNBC version. What is, first off, your expectation for how equities do in the new year?
I'll try to answer them all, Brian. Merry Christmas, Happy New Year. Thanks for having me. Look, I think 2024, it looks like you're going to have accommodation from the U.S. Central Bank, European Central Bank, maybe others. So, synchronized accommodation is usually pretty good for equities. And I think if the median company in the market can have stable or higher gross margins, I think the risk-reward skew to the positive in terms of the outcomes. And I've seen all the year-ahead outlooks now for most of the institutional investors, and I think there's a range out there, but probably a little bit more optimistic than the average from the consensus.
The stock market has kind of gone a little, I don't want to say crazy, but it certainly popped on this Fed pivot and the expectation, Adam, as you know, that the Federal Reserve may end up cutting rates maybe in early 2024. I know our next guest may disagree on that just a second, but how much of the stock market next year, and I'm talking about the S&P 500, just the macro market, Adam, will be reliant on what the Fed does versus what it can do on its own?
Look, there's two elements to answering your question, Brian. One is the corporate earnings, profitability, margins, and the other is the multiples, the so-called price-to-earnings ratio that you pay. And, the Fed certainly, the week-over-week change in the Fed balance sheet has been statistically significantly correlated to the equity market. When the Fed's accommodative, it's usually good for multiples. So I may not, I personally don't think they're going to cut anywhere near as much as what's in the price. But if they start doing it in the second half of the year, the market's anticipatory. I think on the earnings side, there's a plausible case that the average company can have margins that expand some. The median stocks margins have kind of flattened here the last 2-3 months after going down a lot over the previous 18 months. So I think there's a chance that some companies can see some margin expansion. That would be the cocktail for a bull market, would be eventual accommodation plus rising margins.
What parts of the market look better than others?
I do think most of the institutional investors I talk to think there's going to be a pretty big rotation in January. There's just too many stocks underneath that are up a lot in the last couple of months, and some businesses that are pretty attractive if we don't have a recession, things like payments, healthcare services, maybe even some of the more macro-sensitive sectors like energy and metals could benefit from a rotation, maybe out of some of the high-flying tech or some of the retailers, which are up a lot and probably don't have great long-term prospects.
Yeah, when you talk about rotation, are you talking about out of big tech and the Mag 7?
Maybe a little bit less those guys, Brian. My view has been and remains anyone who's trying to beat the S&P 500 should be close to market weight, the aggregate, Magnificent Seven. Why? One, they're pretty macro stocks. I mean, there's very little idiosyncratic risk to them. Two, it's really hard to know something about them that other people don't. I mean, there's 60 sell-side analysts, and what do you tell me, 4 million buy-side analysts who cover them. So the odds that I know something about Google that nobody else does is exactly zero. And then three, I can't really replicate them with another basket of securities. So I can't find 30 stocks that trade just like Apple, so I don't need to own Apple. So given that, I think people should be kind of market weight that group, make their bets on alpha elsewhere. And most people, particularly institutional investors, have all kinds of rules that have prevented them from owning enough of those securities. So I tend to think they're going to be fine, and I would own at least a market weight chunk of those. Maybe you like NVIDIA more than you like Apple or whatever, a couple % here or there. But I would own a chunk of those and make my bets elsewhere.